Hi guys, it's Michael and Ewan back once again for our third learning exercise in the financial modelling section. This one is the budget variance analysis learning exercise. This learning exercise is a relatively short one, but a fundamentally important one that builds on the annual forecast modelling exercise and the rolling financial modelling exercise, which is the historical and forecast modelling exercise. Now, this budget variance analysis is a very particular implementation of rolling financial modelling, in that we basically have a process where we're going to talk about how you create a budget and then how you roll forward the model each month for updated new data. Then you import your updated data and do a reforecasting process. So basically the scope of the model is that it's a Wall Street promotions model, but instead of it being annual, which is what we've been doing to date, this one is going to be a monthly historical and forecast model, which is more commonly what's used for budget variance analysis. So this model is initially going to start with 24 months, of which 12 are going to be historical periods and 12 are going to be forecast periods. And we're going to start with basically a monthly historical and forecast model, which is the monthly equivalent of the annual historical and forecast model we did in the annual historical and forecast model learning exercise. And then we're going to convert that monthly historical and forecast model into a rolling budgeting and planning model. Now, it's obviously already a rolling historical and forecast model in that we could just roll it. The difference between a normal historical and forecast model and a budgeting model is that we actually store a budget for comparative purposes. Now, the process it's worth looking at here. The process overview, which we refer to effectively as rolling budgeting and planning, is that you effectively use your financial model forecast to create a budget. And you normally do that. So in real life, what you'd have here is you'd have a company with at least 12 months of historical data. They would then forecast at least 12 months, normally in line with the new financial year. Those 12 months of forecast would then be effectively stored as hard-coded numbers at that point in time as your budget. And then as you roll the model forward and include new historical data throughout the year, you then actually reforecast and compare your new forecast with your budget you set at the start of the year. Now, the process of reforecasting is basically changing your forecasts as you roll the model forward throughout the year. You can technically have as many budgets as you like. You can rebudget. But that process of comparing reforecasts with new actuals with the budget that you've saved is called budget variance analysis, and seeing basically how your actual performance and your reforecasts vary from the budget that you set at the start of the year. In a perfect world, you'd set your budget at the start of the year based on your forecasts. You'd achieve your budget exactly as planned, and there'd be no variance, and you'd go, why do I bother with the budget?
Yep.
The reality is they're almost always different, and that's what these tools are really powerful for. So what we're going to do to start with is we're going to open up the Wall Street Promotions monthly historical and forecast model. And I say that in that it's not currently a budget model. It doesn't contain a budget. So this model is as I said, the monthly historical and forecast version of the annual historical and forecast Wall Street Promotions model that we built in the historical and forecast learning exercise. And it's basically just contains 12 months of historical data and 12 months of forecast data. So if you go to the time series assumptions in this model, which are in section 2A, sheet 2A, just go to the time series. So in this model, in this exercise, we are just doing 24 months of historical data. And we've got 24 months of total data because we wanted to have at least 12 months of historical data.
Yep. And
that means you can do things like year-on-year comparisons. So you see here we have, now normally in a budget model, at a bare minimum, you'd have 12 months. You might have 24, 36 months of historical,
yep,
and then you'd forecast at least 12, 24, 36 months of forecast. This is sort of the smallest model, the smallest number of periods you can have for a budgeting and planning model. So we have 24 months, and you'll see that it's December year end. The first month in the model is January 2018. So we have the whole 2018 financial year in historical data, and then we have 12 months of forecast. So if you go to the historical income statement in the table of contents, you can see the historical income statement contains a whole financial year.
Yep.
And that's sort of important for comparative purposes. And then if you go to the all periods financial statement, so actually just go to the revenue and expenses projections and just check that we have 12 periods of forecasts.
12 periods.
And you can see we've got that hidden columns approach that we took, the sliding doors type approach we took in the annual historical forecast. So there's our forecast 12 months, so we can ignore those. There's our forecast 12 months, and if we go to our all periods financials, we have 12 months of historical, 12 months of forecast, and that's exactly what we covered in the historical and forecast model learning exercise, only this is months. So there's a lot more periods, but it's exactly the same concepts.
Yep.
Okay, so the process of putting a budget in this model is quite simple. A lot of people get really confused by budgets, and they sort of think of budgets completely independent of their financial model. And that's because a lot of people have disjointed ERP systems, and they've got a spreadsheet that does this and an ERP system that does that. If you build a good rolling planning model like this, what you can actually do is just use your 12 months forecast at the start of a financial year to create your budget. So to do that, what you want to do is effectively take a snapshot of your forecast your forecast income statement at a minimum. You could technically do a forecast income statement, balance sheet, cash flow. You could do even budget could include drivers, so you could actually look at budget variance analysis on your actual volumes and prices.
Okay.
This is just a simple starting point that is a good foundation for any sort of budgeting and planning model, which is focusing really on profitability and the income statement. Okay, so let's insert a budget income statement. Go to the Modano tab, insert menu from web, and scroll down and find the budget income statement chart of accounts 1 module, which is basically an income statement specifically for budgeting purposes based on the chart of accounts we've got in this workbook.
Yep.
Let's insert that. Okay, now the budget income statement, when this goes in, you'll see it's basically a complete replica of the actual all periods income statement, but we can specify in the time series assumptions how many periods we want in it. It's normally 12 months.
Yep.
You normally just do one financial year and you compare it to time just to keep things simple.
Okay.
And then basically we're going to grab the data out of the income statement, the forecast to populate that. So you'll see here, we've got January 2019 to December 2019, which is the forecast 12 months in the model. Now, if you go back to the time series, you'll see that the time series, the assumptions down below the budget time frame says, what's your first budget month? And if you look at that drop-down box there, the first budget month we've got at the moment is the first forecast period in the model.
Yep.
Because this model has, it basically has historical data up until December 18. So we have a budget starting in the first forecast period, and it's 12 months. Now, if you change those, you could make the budget longer or shorter, just like you do when you stretch the model or roll it.
Of course.
But in this case, let's go back to the budget income statement, which will have appeared. It's basically an assumptions piece. So you'll see the budget income statement is in 2D.
Yep.
And all it is a bunch of assumptions perfectly mapped the categories to the income statement, so we can import that data. Now, because they're perfectly mapped, the import assumptions tool can be used to do this really fast. So if you load the import assumptions tool from the Modano tab, get data group, import assumptions, what we're going to do is we are going to import these the actual forecast income statement data into this as just assumptions, so that then when we roll the model forward and we reforecast, this will stay the same and we can compare them. That's our variance analysis.
Okay.
So what we really want to do is just take a snapshot of the income statement, which means we're going to import the income statement from the income statement forecast. So in this case, select module component in this step as the source. And you'll see if you click the drop down in there, it's picked up the income statement because it recognizes that we're in a budget income statement and says, well, you probably want to import the income statement. So make sure you've got the income statement selected and then press next. And you'll see here, because the categories are identical, sorry, I'm jumping a bit far ahead here. So you'll see here it's saying, it recognizes there's no data in it, so it's saying grab from January the whole way through to December. It's going to do from columns V to AG, that's fine. We don't need to reverse columns because it's a replica, and we don't actually need to use a mapping file because the mapping is going to be exactly the same because it's going from the actual income statement to this one. So if you compared that budget income statement there that we've got in the background to the income statement in the model, it would have the exact same categories and rows. So because it's linked to it, that's what it's designed to do. So if you press next, you'll see it will automatically link straight away. And there you go, you see there's no difference. And if you click on the right and do left and right like we did in the rolling model, the historical forecast model, there's no variance or no difference in any period between the target and the actual. So you can just press import.
And then we'll drop them all in.
And that'll drop that in. You can see we've got, if you go down to net profit after tax, we've got net profit after tax starting at, what is that,
29.9.
29.9 going up to 27.1.
Yep.
If you just go to your actual income statement, you can see you've got the historical periods, but if you look from January onwards, from January 2019 onwards,
29.9
and scroll to the right, that should be 27.1.
Perfect.
Okay, so they're pretty much identical. So what we've done there is we've just taken a snapshot of the forecast income statement in this model. So we're using the model forecast to create our budget. And that's the key to this. So you don't have a separate model to do your budget.
No.
So it gives you the full driver-based controls of this model to do that. Okay, so what we're going to do now, so let's just go to, let's have a look at the budget income statement outputs in 3B. The budget income statement outputs are pretty simple. It just shows you the budget variance. So it's got the income statement linked in down below. And if you look at those rows, if you open up revenue, for example, that's literally just linking in revenue. So if you look at that, it's direct linkages through to and the reason why it's got the offset in there is because obviously the all periods income statement has 24 periods. This one has 12, and we've said we want the budget variance analysis to start in January, which is actually if you do Alt LUR on that, the drop down first budget month. If you click on that, the first budget month is going to actually move it across. So you'll see there, the first budget month is actually month 13.
Yep. And
if you click on the offset in the traverse, it'll wander across, I think. There it goes.
Yep, I'll move that out of the way, do that again.
There you go. And there, so it's moving across to there. Okay, and that's all it's doing. It's just doing that offset to facilitate the fact that you don't have the same budget starting point as your all period starting point.
Of course.
For all your data. But that's it. So if you cancel that dialog, and go back, you can see at the moment we have no budget variance. So if you go to the budget variance up there, the budget variance analysis is just saying what's my budget number, and just do traverse on that as well. You'll see it's taking the assumption number and saying, okay, let's look at the assumption number and subtracting it from the actual income statement number, saying what is the difference. At the moment, there is no difference. So we have 0 budget variance analysis, which is what you'd expect because at the moment the budget equals the forecast.
Correct.
Okay, so let's roll forward this model.
Right.
Now, this is where we refer to the sliding doors, where at the moment we have 12 periods of historical, 12 periods of forecast. Our historical financial statements are on 12 periods of purely historical data. Our forecast analysis is on 24 months, of which we're hiding the historical because that's all where the derived cash flow stuff takes place, and you can only see 12 forecast periods. But it's effectively a sliding door in that we're sort of hiding the forecast periods under the grouping. And then the all periods has the 24 periods. So what we're going to do to roll this forward, I'm going to show you the process on my screen here in the PDF, is basically at the moment, so the roll forward process, you basically start with your historical income statement and your forecast. In this case, we've got 12 and 12. So 12 historical, 12 forecast, and the all periods grabs historical data from the historical financials, and then does forecast data from the forecasts, and obviously derives the historical cash flow for the historical periods. And then when we roll forward, what we're going to do is we're going to add a period to the historical income statement, which is going to make a period of forecast inactive, which is January 2019, and our all periods are going to grab 13 periods of historical data and 11 periods of forecast data. So this is called a roll forward. And at that point in time, we'll be able to then we import our new data for the January period, which is now available, and we'll be able to do budget variance analysis on the actual data that eventuated versus what we forecast at the start of the year. So this is something you would do a month, normally at least a month after setting your budget up. Okay, so to look at how you do this in the model, it's all automated. This is where this course is so small because this is normally painful stuff. So go to the table of contents and go to your time series assumptions. And you'll see down below we have the historical and forecast timeframes. We're going to change that from, now just go back to your historical income statement and just confirm to make this clear. Your historical income statement currently has 12 periods, all with data ending in December 2019.
Yes.
So now we go back to our time series and change the last historical period to January 2019.
So we're now at the end of January 2019 wanting to import the latest actuals.
That's it. So you're probably in early Feb.
Okay.
Your bookkeepers have said, or you're the bookkeeper, or you're the accountant, you've said, okay, I've got the numbers in. Let's actually roll forward the model and see how they compare with what we forecast for this month. Okay. So when we do this, the dialog comes up saying, are you sure you know what you're doing? It's going to add a period of historical data. It's going to basically group and hide an extra column within the forecast. You say, yeah, that's fine. You update. This goes and adds a column to the historical income statement and the historical balance sheet. So you'll see now it doesn't change the first budget period because that's still January. Now, if you go to your historical, you'll see we've got alerts because we've got a hole. We've got no numbers in the historical income statement. So if we go to our historical income statement here, we now have an extra column available with no data in it, and the same with the historical balance sheet.
So that would be, yes, over here?
Over there, yep. And then we also have, if you go now to your revenues and expenses and all your forecasts, you'll see that column that now starts in W. If you ungroup those rows, or if you expand those, you'll see column V is now part of those collapse rows.
Yes.
So because they're inactive assumptions, the data is now coming from the historical income statement, so we need to import that data.
And that is automatically grouped and hidden away. So the conditional formatting showing that it's now inactive, but the assumptions are still there in that cell. So I could still roll the model back, and that data wouldn't be lost. It's not deleted.
Exactly. We haven't had to move any assumptions at all. Okay, so now what we want to do is import new data into the historical financial statements. Now, if you go to your assumptions file for this exercise, which I think you need to open. So you open the assumptions file. You'll see that this assumptions file is literally what you get for the month. So it's the January 2019 income statement, the January 2019 balance sheet, and then the revised forecast. This is where the strategy team's come in and said, listen, based on January, we think we're going to do better or worse, and we're going to see that. So we can do our reforecasting. So first of all, we're going to import this data. So if you see here with the income statement there, this is just like what we did in the historical and forecast learning exercise. We're going to use the import assumptions tool. So go into the actual financial model and go to the historical income statement. I would select, just to make it easier, so the dialog picks up, I would select something in the empty column across the right, across there, and I would just do import assumptions. So Modano, get data, import assumptions. Just select Excel again. We're going to be automating this process with Xero and QuickBooks and a whole of other ones soon so that you can just refresh the model on the roll, which will be awesome. At the moment, you do need to spend a couple of minutes doing it. But when you've got big consoles with multi-entities, it's going to be great to automate it all. So in this case, we don't want to import from like a module component. We want to import from the assumptions file. So you can see you've got the assumptions file selected. You've got the income statement selected as the sheet.
Yes.
You can just click on that to make sure it's correct. You see that that's grabbing the data
Yep.
from there, which is
That's
fine.
bringing everything.
Cool. And then, so press next on this, and you'll see here we have an existing mapping file. So when we created this model, we created a mapping file, which is what we did in the historical and forecast learning exercise. We actually said, let's create a new mapping file, and we did that so that now when we roll forward, we don't have to respecify data.
Right.
So the only time in which new accounts would need, which mapping would be required, is if the chart of accounts has changed, or you've renamed either the category headings in your module, in your model, or the category headings in your chart of accounts in your accounting package. Okay. So here we're just checking. We are bringing January 2019. You'll check the export range. If you check that, is D, which is what we expect. It's just that period there. Great. And then we're not going to bother reversing columns. We're going to use the existing income statement mapping file.
Mm-hmm.
So click next, and let's see if it automatically does it, which I think, so it's off by 1. Now, it's off by 21. What that means, almost in every instance, is that something has changed to our chart of accounts. Now, if you look at the source accounts on the left, you can look at which ones are in red to see which ones have been mapped and which haven't. So you can scroll down and just look for anything that hasn't been mapped. So see, income tax expense hasn't been mapped.
Mm-hmm.
Right? Now, if you look down on the right, income tax expense doesn't have a value in there.
Mm-hmm.
That's because in the model, I think we've changed the name to tax expense, whereas it used to be income tax expense, so it doesn't know what to do with it anymore, because it all just searches for the names that you map to.
Yes.
So if you just grab the income tax expense and plop it on top of that one, that reconciles, and just click in the right side and just use your left and right. Just do left and right arrows. Just make sure that you reconcile for all the other periods. It's just
We've
one
only
period.
got one period.
Just one period, so it doesn't matter. Okay, and you're done. So now you can import.
Now
And there
that's
you go.
dropped it in.
And now that's in there, and that will reconcile that. Net profit after tax of 44.2 is the correct number. So let's just do OK for the balance sheet as well.
So yes.
Yes, sorry. Just click yes, and this time we're just going straight in and doing it. So click next. We know we want the financials file. We need to change the rows range this time to the balance sheet. So just
Go
click
across
balance
the
sheet file. Yep, and just click the whole lot. That's fine. Okay,
Now
and just press next. And this time it's exactly the same as last time. We have an existing mapping file, which is the historical balance sheet mapping file.
Yep.
Everything else on that page is because we selected a cell, because you start off by selecting because we've got the empty row at the end, it automatically suggests January, so we can click next. And this one has no chart of accounts changes. So this one just works, which is the case 90% of the time. If you mess with your chart of accounts, you're going to pay the price. That's just how it works.
Yeah.
But in most cases, you don't need to worry. So now you can just press import and it will work.
So that's mainly the whole set and forget aspect of it. You set it up at the start and then only need to map changes rather than going through that mapping process every single month.
Absolutely. And if you do it right, especially with the live link functionality we're about to release, you should be able to roll your model forward each month and it will just update. And you can just check. So if you look at your net assets for that January 2019 period, we have a net asset figure of
1067.7.
Let's just check that in the assumptions file as well, and just check
So on
that
the balance sheet,
our total equity down the bottom.
we have 1067.7.
Okay, so let's just go to our revised forecasts and leave that for a moment. You see we've got some revised revenue. We just kept it simple. You might want to do a revision of all your assumptions, like interest rates, etc. But we're just going to show the concept. If you go back into the actual model, and now you go to your budget variance analysis, you can see your budget income statement hasn't changed. They were just hard-coded assumptions we put in.
Yep.
So if you now go to your budget variance, your budget income statement's in the output, so 2B, you can see in that first period, if you open up revenue, you can see that we, on the income statement, we actually, the actual revenue we achieved was, this is interesting to do. So go back to the budget income statement, the assumptions. You'll be able to use those arrows, yeah. You'll be able to use the bottom arrow and go cycle around. So you'll see we budgeted on, what is that, 475 of revenue, so 301.5.
Yep.
And now if you go to the outputs and you look at the actual income statement, which is we actually achieved, say, 314 for that, which is 12.5 below. So the budget was above. So above, right? So what was the original?
So it was 301 and we achieved 314.
We achieved 314. So it's 12.5 above. Okay.
Yeah.
So now if you just go to the all periods income, all periods financial statements, and you can just see that, just confirm that the actual revenue for January is coming through there. That's that number there, which is the 314. So you can see that difference. So if you go back down now to the budget variance analysis again in the outputs. So you can see here that basically the flow-on effect of that is obviously that doesn't. We've got profit. We've got revenue. Revenue is actually 22 higher than we expected. Our expenses were a bit low. Our expenses were a bit higher than expected as well. On that, so our actual earnings was 16.7. 16.7 higher than we expected. Now, because we pay tax on additional earnings, it comes down to 14.3. So we end up being 14.3 net profit after tax ahead of what the budget was forecasting, which is a good outcome. So let's now go in and put some reforecasting in. So go to your revenues and expenses. And you'll see in our revenues expense assumptions in 3E, you can see there are projections at the moment. Let's go into the forecast in the assumptions file and put these in.
So it looks as though we've got slightly higher forecasts based on January's performance.
That's it. So we'll put those in, and now let's go and look at the budget variance analysis and the outputs. So 3B. Yep, there you go, and you can see we're forecasting. So if you just do a sum of those 11 periods across the bottom. So we're forecasting an increase of, what is that,
389.7.
That above what we actually originally expected in the budget. So that's quite a serious reforecast. So that's good times. So the only issue with this is it's quite hard to see. The budget variance analysis here is nice and tight. It's just numbers. What we often want to do is show budget variance analysis on a graphical output. Okay, so we've got a really good dashboard for this. It's called the budget income statement dashboard. And it's a dashboard that literally shows the comparison of and we're going to put this in now. I think that's all we have left. We've done the reforecasting.
Yep.
So what we're going to do is we're going to put in a budget income statement summary dashboard that's just going to show this in a much more presentable way. Okay, so let's go insert from web. And
loading that.
And this time we're going to select a budget income statement summary dashboard, which is just below the budget income statement, and insert that. And this is very similar to the financial statement summary dashboard, but it's focused purely on showing differentials. And what we've done in this dashboard, which is pretty cool, is we've just used conditional formatting to highlight where things are above or below what you'd expect.
Okay.
So I think we've actually used conditional formatting to highlight when revenue is below what people expect or costs are higher, because that's really that shows bad things.
Yes.
So you'll see here when this comes in. If you scroll down and look at the budget variance analysis down below, that's variance. That's a projected versus budget.
Mm-hmm.
So you can see we outperformed by 22.5. We're expecting to sort of underperform slightly, but it's a bit of a rounding. Was that 0.9?
0.9.
9, but on the whole, we're actually outperforming by 252. And you can see tax expense is higher, which is what you expect when you're making more money.
Mm-hmm.
And the other operating expenditure is a little bit lower, which is what you expect when you've got higher revenues. So expenses are slightly higher, but revenue is a lot higher. So we've actually achieved higher margins than we expected. And as a result, we're more profitable, we pay more tax.
Yes.
And if you scroll up, you can see what we're showing in here is the budget income statement versus the actual income statement up above. Mm-hmm. And on the right, we have top revenue and expenses, just seeing where the actual outperformance is being achieved. So you can see, this is a very simple example, but you can see we're basically outperforming on revenue. We're basically outperforming the variance in almost every single period across all categories, give or take, so 4 of them. So it's a really clear way using conditional formatting. And that is the budget variance analysis. So just to cap off what we've done here, we've taken a rolling historical and forecast annual model. We've forecast 12 months, which is normally an entire financial year.
Mm-hmm.
We've then taken a snapshot of those forecasts and put them in a budget income statement module, which is just fully assumptions, which then calculates the variance between the actual forecast in the model and the budget and the budget which we stored. And then we've actually rolled the model forward, included new data for January for the latest historical month, and then we've done a reforecast of our revenues, which we could do for all other items, and we've included a budget income statement summary that gives us the budget variance analysis. And that process, in perpetuity, is rolling budgeting and planning, and
Correct.
it's the key basically to the best thing about this model is unlike a basic say cloud app that'll give you just a basic cash flow forecast. We've got a full integrated 3-way, and you could extend the budget to include drivers, balance sheet, cash flow. It's a fully integrated investment banking quality financial model that can also be doubled up and used as a budget variance analysis tool.
Yep.
So that is really the icing on the cake for the financial modeling exercises up until this point. So you basically have your annual forecast model just for basic forecasting, where you don't have to worry about rolling, but you don't get the historical comparison purposes. You've then got the inclusion of historical data, which is the historical and forecast rolling piece. And then your budget variance analysis is the budgeting layer on top of that, which enables you to compare what you said you would achieve or hope to achieve with what you did. And that is the piece de resistance of strategic planning. Hope you guys have enjoyed this series. This, I think, at this stage is the end of the financial modelling section
Correct.
of the training. We have a whole lot of more advanced training on top of this, which you're more than welcome to dive into. But this stuff is the fundamentals. So if you haven't understood anything, we recommend going back and looking at it again. And as I said, we have a support system on our website if you want to have a chat or want some custom training. So thanks for watching.